Hello, and welcome to the latest instalment of Market Financial Solutions Conversations with Connor. Before we dive into today's episode, I want to take a moment to share a quick disclaimer. Market Financial Solutions are a bridging loan and buy-to-let mortgage provider and are not legal, financial, investment, or tax advisors. This document is for informational purposes only and does not and should not be considered to constitute legal, financial, investment, or tax advice, or be relied upon by any person to make a legal, financial, investment, or tax decision. Therefore, investors are encouraged to seek appropriate professional advice. The opinions and views expressed in this episode are personal to the host and may not reflect the views of Market Financial Solutions. Now let's get started. Activity in the market is being driven by a few surprising demographics at the moment. The FCA and the PRA released joint figures in June showing Britain's mortgage market witnessed a dramatic resurgence, which was led by a record-breaking surge in first-time buyers specifically. Of all house purchase advances made to owner-occupiers, 31.4% were to first-time buyers, the highest share since records began in 2007. Yet, on the other end of this spectrum, later life loans were up 33.5% year-on-year in Q1, according to UK Finance. The bulk of this came from new lifetime mortgages, but retirement interest-only mortgages, residential later life loans, and buy-to-let later life loans were also prevalent. All of this appears to be on the radar of the regulator, with the FCA launching a discussion paper in late June on the future of the mortgage market to help first-time buyers, the self-employed, and people borrowing into retirement. May, by all accounts, was also a particularly busy month for housing. Rightmove data showed that last month was the busiest May for agreed property sales since 2021. Geographically, Hayward in Greater Manchester led regional growth with an 88% year-on-year jump in transactions. Pudsey in West Yorkshire followed this with an 85% increase, and Wilmslow in Cheshire saw sales climb by 66%. London recorded a marginal 1% rise, which may not seem like much, but there are signs that the capital's property market is on the verge of a rebound. It turns out that as non-doms retreat from the UK, British families are seizing the moment, to quote, in snapping up bargain luxury homes in some of our most exclusive postcodes. Some estate agents say families living in prime areas of outer London, such as Barnes or Chiswick, who may not have been able to afford the prime inner areas of the capital, are now securing a foothold in some of the most expensive neighbourhoods in London, such as Belgravia and Kensington. Across London, it's becoming increasingly apparent that more housing stock, more broadly, is needed to accommodate the city's basic needs and future potential. A new report from the ONS on population growth revealed that London alone needs 600,000 new homes over the coming years, with Tower Hamlets specifically set to be the fastest growing authority with a projected population rise of over 20% by 2032. There's opportunity here for property investors, landlords and developers who are willing to get ahead of any spike in demand. Fortunately, while we're notoriously bad as a country at delivering enough housing to meet demand, there is evidence that we're at least pushing in the right direction. Additional data from the ONS showed monthly construction of private housing grew by 0.9% in April 2025, the third consecutive period of positive growth. More development means more potential opportunities for property investors. In the current market, though, there are a few clear assets that are drawing attention for their appeal. A recent survey of UK landlords revealed that an overwhelming 92% of them say tenants will pay a premium for greener homes and commercial premises. 77% reported a surge in demand for heat pumps, solar panels, and electric vehicle charging points. And also on this, I've been interviewing our BDMs for their thoughts on what's going on in the market in order to create profiles for them, for their brokers and other stakeholders. And side note, keep an eye on our website for these. And across all regions, one property type keeps on popping up in these interviews. It appears property investors of all shapes and sizes are keen to invest in HMOs for their rental potential. They may be onto something here, with research from Coho finding that the bigger the HMO, the better the yield, even when taking into account the higher upfront costs. 5 and 6 bedroom HMOs offer the highest yields at an average of about 8.7% across England. Average yields on 4-bed HMOs are 8.5%, and for 3 beds, it's 7.1%. But of course, certain cities have even better yields that can be found by those who are a bit more selective in where they're investing. In Bradford, a 5 or 6 bedroom HMO can generate a yield of 15.2%, according to their research. In Liverpool, you're looking at 10.8%, while in Leicester, it's 10.1%. And I'm happy to report that it appears property investors in general are turning to the specialist market in greater numbers to take advantage of these kinds of opportunities. The latest quarterly data from the Bridging and Development Lenders Association, or BDLA, revealed new bridging loan completions totaled 2.8 billion in the first quarter of 2025, while new applications surged to 18.34 billion, which was a massive 55%, just over 55% increase on the previous quarter. Hopefully, we'll continue to see optimism take hold for the remainder of the year as well, especially following on from Rachel Reeves's spending review. Some may have been a bit nervous about what the government may have in store for the private sector specifically with this review. The last thing anyone needed was more roadblocks or higher costs. But in the end, the only major property-related announcement was that 39 billion had been earmarked by the state for social housing, which appeared to be broadly welcomed by the wider industry from the commentary that I've seen. In terms of economics, June was a bit of a mixed bag. Inflation fell to 3.4% in May, and the Bank of England kept the base rate unchanged at its most recent vote, but it still hinted at cuts to come. House prices also remained somewhat subdued, according to the latest indexes. Nationwide saw house prices rise by 0.5% between April and May, while Halifax reported a 0.4% dip. And the ONS saw house prices fall by 2.7% between March and April. But Rightmove in June revealed that the number of £1 million listings across the UK has doubled over the past 6 years. And across the UK is the important point there. This is not just in London and the South East. This serves as a nice reminder of the fact that while the property market, just like any investment market, can be hit by short-term difficulties, the long-term outlook will often remain positive. The property market and the investors within it have plenty to be optimistic about for the coming years. Demand is there across subsectors and asset types, and as always, Market Financial Solutions will be there to offer a helping hand for years to come. Thank you for listening, and I'll see you in July. If you enjoyed this episode, don't forget to subscribe, like, and share. You can access our previous episodes in all the usual places, as well as on our website at www.mfsuk.com/podcast. See you next time.